really my epiphany moment came at some point in the 90s, late 90s. It's the middle of tax season, and I'm exhausted. I'm just like, what am I going to do 20 years from now? I don't want to keep up this pace. I wasn't building any wealth, and I wasn't generating a business that, one, I could sell. I had a very small firm. So literally in 2 o'clock in the morning, I'm sitting down and I clicked over to a TV channel with a late night infomercial, which a lot of your listeners may or may not have heard of. A guy named Carlton Sheets. I
Yeah.
mean, I'd seen his stuff forever. $199 money back guarantee, and the whole premise is build real estate. His premise was with no money down, but build real estate to generate recurring income. Well, that makes sense to me. I get recurring income. And so I bought his course, and it really wasn't cheesy. It really wasn't stupid. It was all very good, practical sense. And so I followed his program, and 90 days later, I bought my first duplex, and so forth and so on. So that was my epiphany moment.
Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all. Real estate experiment. What is happening, y'all? Today, I have another gentleman who's in this lab coming from a space that we first set the foundation on when we opened up the lab, and that is the multi-family space. However, I do want to level set because this gentleman that's here with me today has a very unique angle in the way he's able to have grown his company. He is the CEO of Harvard Grace Capital, private equity real estate investment firm that helps people build wealth faster. And as you guys know, what that means is working with other investors to have strength in numbers and to help build the portfolio that you've built over the years. And you've raised millions of dollars through real estate syndications, and you've obviously surrounded yourself with the right individuals, partners, I should say, to be able to get these deals and lock them in. And you do expand. We are just talking about this offline. You'd have Nashville, you have Tennessee, you have Huntsville, Alabama. You're looking to continue to grow the portfolio, but you did just tell me offline that you are very selective in your approach, which I always like to hear as the operator. Not everything's a yes, and there's a specific reason why. So without further ado, I also have to mention, of course, that let me ask you, Stewart, are you still an active CPA, or is that more of a recovering CPA now that you kind of dove into you bit the bug, you caught the bug, and you're drinking the Kool-Aid? Stewart Heath, welcome to the lab. And without further ado, I want to actually give you an opportunity to say, so how do you, when you and I sit down, if we're meeting at a meetup or if you and I are meeting on a show like this, typically, obviously on this show, the narrative is real estate, but when I meet you and I say, what do you do for a living? What do you say?
First, thank you for having me. It's an honor. The way I answer that question, Ruben, is we sponsor and operate real estate syndications for commercial properties in the Tennessee Valley area. That's what I say.
Okay. So now I see the CPA after your name, so you got to tell me a little bit of background here, because I do believe that our business is a reflection of who we are. So what's the background there? And at what point did this happen, Stuart?
Yeah, my dad was a CPA. It seemed like a good idea at the time. I am still an active CPA. I still have a few tax clients because I cannot fire my mother, and a few others that have haven't found other better people. I've got some 35-year relationships, and I'm still a fractional CFO. That's really where my business has been for the last 15 or so years. But I am very blessed to be able to be very selective in those kind of clients as well. So I haven't closed the door on that. But so I have a half dozen or so of those type clients as well. still an active CPA. I do think I subscribe to the recovering aspect of that too. I was never the traditional accountant, green eye shades and pocket protectors, and I was always about more entrepreneurial. Even when I had my own practice, I'm like, how do I grow this thing? And then I kind of realized I don't want to grow this thing. I don't like this business. I don't like the model. So I began to model what some of my clients were doing, which was real estate investing, and here I am today. So
you know what's funny? I find that fascinating, and I think it's important for us to highlight, Stuart, is that often we sometimes overlook, and I know I'm in this space. I've been an entrepreneur for quite some time now, so I'm definitely in the entrepreneur kind of fast lane of like, oh, like I got some friends saying school was a waste of time, etc., which I don't believe is true. But I have those drinking all the Kool-Aid all the way, and then there's the other ones who it's kind of like they leverage their job to then see an opportunity to then be able to tap in, which is how I saw my opportunity. I was specifically a realtor for the investor, and I learned along the way while I was working with them. What common things did you see that kind of hit that light bulb moment when you were working as a CPA, especially being close to the numbers? I actually love that. What did you see that was like a common denominator that kind of just jumped out at you on the sheet, for lack of a better words?
Well, really, my epiphany moment came at some point in the 90s, late 90s. It's middle tax season. I'm exhausted. It's probably 2:00 in the morning, and which is great. I always loved tax season because I was billing all kinds of money. I mean, making lots of money, but I wasn't building any wealth, and I'm exhausted. I'm just like, what am I going to do 20 years from now? I don't want to keep, I don't want to keep up this pace. And I wasn't building any wealth, and I wasn't generating a business that, one, I could sell. I had a very small firm, and I wasn't generating anything that would make income without me specifically billing time to generate that income. So literally, in 2:00 in the morning, I'm sitting down and I clicked over to a TV channel with a late night infomercial, which a lot of your listeners may or may not have heard of. A guy named Carlton Sheets.
Oh, yeah.
And I'm a little bit older than you, and he's been off the air for a long time. But and I
know who he is, by the way.
Yeah, I mean, I'd seen his stuff forever. $199 money back guarantee, and it's all about real estate. I've had many clients who started out as fixers and flippers. Some of them dug themselves out of massive holes of debt to where they're now. Well, several of them are now my lead investors in some of our deals that we put together. And it was, the whole premise is build real estate. His premise was with no money down, but build real estate to generate recurring income. That makes sense to me. I get recurring income. And so I bought his course, and it really wasn't cheesy. It really wasn't stupid. It was all very good, practical sense. And so I followed his program, and 90 days later, I bought my first duplex, and so forth and so on. So that was my epiphany moment.
I like that. And I want to touch on what you said, because you talked about wealth, and you talked about making a lot of money. Let's put some things into perspective. I think, and I always like to kind of lift the hood a little bit, just to, I think you can catch some people in the same situation. They'll have an inflection point, a reflection point, whatever that is, and that's why we do what we do. But when you say good money, I'm very curious. What is it like? Because I have an accountant, and I know exactly when I should not hit him up, when I should hit him up. I know what's busy for him. I just spoke with him 2 days ago, actually, on some tax strategy, and he's wonderful. Shout out to Dave if you're out there. But for you, what does it look like for just so we understand the business model, and then we'll transition to real estate. I want to understand your lens. What did it look like before when you're making a lot of money? Is it just, are you billing a retainer? Are you billing every time you file? And then what kind of money are we looking at when you've been doing it for so long? I think you've been doing it for 35 plus years. Like, what did that look like for context?
Oh, well, back in the day when I was, quote, making a lot of money, I was probably doing, 200K a year uh, take home for me. That's after the business expenses and office rent and all that kind of stuff. Pretty much billing by the hour. I had a few recurring clients that were paying a monthly rate for some accounting and bookkeeping work, and I was pretty much by myself. Um, I, I've never been really good at making good hiring decisions, and on top of not making good hiring decisions, I would make really bad firing decisions by not ripping off the band-aid. But I never had any interest in building up a firm. So the whole public accounting model never appealed to me,
Yeah.
and I started my career with Price Waterhouse,
Oh, wow.
and learned a lot from them, and totally respect that time. But I knew I didn't want to do that, and so I did go out on my own. So I wasn't trying to find my next career on somebody else's dime. So I kind of started my own firm, knowing that wasn't my full-time gig. But hey, here I still am doing some of it.
Yeah.
So,
Well, I'm interested because I want to see how that transition over to the syndication model, et cetera, because there's a lot of people who are doing it themselves and doing it that way. And then there's people like yourselves who are leveraging others. So I want to see what that kind of, how that transition out. But would you mind sharing with us what was it that was not appealing about building a PwC firm of your own? Like, why not? Like, was there something that you looked at and you're like, this is not me, and here's the reason why? What was that?
yeah, I when it comes to detailed work like that, uh, the potential for mistakes. Gee whiz, we did this, and now we got to amend your tax return. That just kind of drives me crazy. And I was okay enough handling my own mistakes, but I didn't want to hire people and not catch their mistakes and then be responsible. It's just a mindset. I'm not saying it's the right mindset, but my dad, who was a partner at Ernst and Winnie for years, said, "Well, you can't get rich selling your own time, but you can get rich selling other people's time."
Mm.
And so he went his entire career with that firm and ended up being a partner there, and so he did quite well selling other people's time. But I just didn't want to be responsible for my employees' detailed work product, whether that be for audits or tax returns or bookkeeping work. It just seemed like there was really no way to really excel the way you can by so getting an investor to subscribe to an investment, and he's expecting an 18% IRR, and then you deliver a 22% IRR. I mean, that's not to say that I didn't make mistakes along the way from the pro forma through the operations on in, but end of the day, we did better. And so to me, just the effort that you put in is just so much more rewarded by putting it into the investment side of things. Here's a case in point, sort of an additional example. I had one client who he had an S corporation. He had an operating business,
Mm-hmm.
and hey, what are we going to? And he just sort of suddenly turned from losing money to making money. He'd been building his business. He's a really good operator. And so it was early in the year, but and so very quickly I realized before March 15th, he could file an S corporation election, and that applied to the entire previous year. And that ended up saving him $30,000 or $40,000. I mean, that's been 25 years ago. And I got to bill him 2 hours of time. So I billed him 2 hours of time, which was probably $125 an hour at the time. I billed him $250, and he saves $30,000 to $40,000 in taxes. And you know what he did? He changed accountants the next year. And you know, more power to him. I don't even remember what the issues were, but you know, I did my job, and not only did I not get paid for it commensurate with the value, there was no loyalty involved. So I just that kind of thing has repeated over and over and over again over the ages, and I think most accountants will attest to that. And then on top of that, you have employees, and then they leave and they compete with you and take some of your clients and all that. It's just not an enticing model to me. Whereas investments, you know, you at least get compensated based upon performance and the size of the deal, and when you win, you know, I think most people are more inclined to continue to invest with you.
I love that, and that's such a critical. Okay, I appreciate you highlighting that difference, and when you're thinking of almost the compound effect, the exponential growth that's within that business model compared to the one that you came from, it justifies the reason for making that leap. So let's talk about it, because you went from making money to, you mentioned it and you said, you know, I pay attention when someone like you is here and speaks. You know, you said money, and then you started talking about wealth. So let's go into that area, right, where you transition. You started with the duplex, and then what made you say, okay, I'm assuming the duplex was with your own money, right?
Yep.
And now, how did you transition into larger deals? What was that? Talk about that transition.
I first started doing larger deals with partners, where we all chipped in some money and guaranteed the debt together, and that can be, I mean, they were rewarding, but they can also be complicated. I do like to be in control, if you take my meaning, and because I'm very proactive, and when you're having to drag some of your partners along to make a very common sense decision, you know, it gets exhausting. So not any real bad experiences there, but so I just gradually moved into the model of, all right, if I'm going to make all the decisions, and I'm going to find the deal, and I'm going to put the whole deal together, and I'm going to find the lender, and so forth and so on, then I just want to be the GP. And I'm happy to have other people along, and I'm happy to, and I need other people along, but people who don't necessarily want to be making the day-to-day decisions. One of the things that we do that's different from other syndicators is that if we do a deal, we're also the day-to-day property manager of the deal, not just the quote operator asset manager. So which is why we focus on a geography and not just an asset class. But I've had such negative experiences with most third-party property managers. To me, it was the only way to make sure that we delivered the business plan that we just sold the investors. And so, yeah, I get paid for that, but we're not making any money on that. I mean, we're pumping, you know, 3 times the amount of time into property management on an asset than, you know, your average third-party manager would do. So.
That sounds like a moat to me. So you mentioned GP, and for our listeners, a general partner. So is it just you, the general partner, and then you have limited partners? Is that how you structured it today, or has that changed a little bit?
Harbor Grace Capital is the general partner or the sponsor. I know we use these old terms like general partner and LP, limited partners, as if anybody's doing limited partnerships anymore. Everybody I know uses LLCs, and those titles don't actually exist. But so it's me. We have a board of directors who are also active investors, and we've done a deal or two with some co-GPs who've helped bring some capital and some expertise to a deal. And so it's not always just us or me. We have other people along.
Got it. And now for that's very interesting. What does that look like for some of our listeners who are coming from different kind of walks of real estate, right? Some of them are in maybe in the short-term rentals, some of them vacation rentals, some of them are storage. When you say the structure, the behind-the-scenes structure, it seems like it's on a deal-by-deal basis, but it also seems that you're building a portfolio. So when you're putting a deal together, how are you structuring it first, and what comes first? Is it we find a deal, then we put the team together, we use the same team to find the deal first? Like, explain to us how that's structured so we can get a better understanding of how you're operating at that level.
Yeah, it's both and. We're constantly reaching out to make relationships with new investors, and we're constantly looking for the next deal. Everything we've done so far is single asset entities, of which Harvard Grace Capital is the sponsor and lead operator of that. And then once the deal comes together, that it's full court press on to get the contract negotiated and in place, and then it becomes full court press to bring all the investors to the table and the lenders. Lenders is probably the easiest piece of the deal, even in today's market, because there's so many, at least in our markets, there's so many lenders out there with capital to loan. They haven't really retrenched; they've just raised their rates. Some of them have. Some of them tightened underwriting standards. The rates themselves is such a limiting factor, to meet cash flow coverages and things of that nature. So right now, yeah, like I said, we're always looking for new investors, and we're always looking for good deals.
Got it. And so are you then, just because we talked about this, I think offline, about the importance of building that network and building a list for, so to speak. Is it that do you have the sponsor, Harvard Grace, has the capital preserved, and then you're raising it to as a leverage point in case that investors are not interested, or you're getting, you're going hard on the deal, right? And then you're raising the capital, which I'm assuming, how deep into the space are you in a position where you could just pick up a phone call and someone will say yes or no, and then you go to the next person? Like, how does that look like behind the scenes?
We have some very loyal investors. And I would say that currently I could make 4 or 5 phone calls and raise $1.5 million or $2 million. And some of that's because they know that we pass on a lot more deals than we do. And some of those are 30-year relationships as well, anywhere from 10 to 30 years. So that's why we're always interested in making new relationships, because you can't have a 10-year relationship until you get started at some point. So, and I don't say that to be arrogantly that yes, but we have some investors that we can pick up the phone call, we can pick up the phone and they're in. It's very humbling and somewhat intimidating, frankly, that we have those relationships, but it's key for any capital company. Harvard Grace Capital itself, we always invest in our own deals, and I say we don't generally do it through the company. We do it individually. So we're always in there with the limited partners, the investor side, as well as everybody else.
And for clarity, Stewart, I appreciate you saying that. Does that mean Stewart Heath is also investing, and then Harvard Grace is the sponsor. Okay, that's very interesting.
Yeah, so Stewart Heath is doing it. Most of our board members are doing it at the same time. Sometimes it's also my mom, so well, that's just you, yeah. But I have siblings I would have to answer to there, if something went wrong there too. So, it's all very we're all very personally in, and I'm generally the only guarantor of the debt, so I'm really in. So, investors rarely ever have to guarantee the debt, primarily because we focus on stabilized deals. We're not doing risky value adds or development deals. So.
Yeah. Can an entity be the guarantor, or do you have to be a person?
In our case, we have two entities that are guarantors, and then but it all comes down to me. Yeah, so they want an individual. If an entity has enough assets and they're willing to block it, then yes, they can do that. So you can cut up, negotiate, and a guarantee just about any way that you can think of. So.
And that would be on the lender side, right?
Yes.
That's very interesting. You mentioned something earlier that, and I'm there's two things that I love that jumped out. One is that, well, I love vertical integration. So as far as having your own property management company in-house, allows you to have control, but you also say you put in 3x more of time that you're using it more as to keep it vertically aligned and control, but not even so much to make a profit on that. What's happening that you're doing it 3x? And to me, when I hear that, I hear a moat or some kind of secret sauce that you kind of been implementing in-house. What is that 3x of implementation? How does it rise to the surface? Because I know it's kind of like an iceberg. We see the surface, but what's happening behind the scenes?
Well, it could be that we're just inefficient.
Experiment Nation, you've heard the word MTR, mid-term rentals, as it is currently a hot topic and hot commodity right now because, again, there has been an increase in short-term rental regulations, and there also has been, let's face it, a slowdown in what we were experiencing a couple years back when it comes to bookings. So with that said, short-term rental operators are looking for alternative solutions to tap into the mid-term rental space. However, there is a sub niche of mid-term rental insurance that I'm truly excited about, that I want to share with you, that the experience that we've had, the tremendous results we've been able to have, and that's the insurance mid-term rental space, which is very different than your traditional mid-term rentals. When you think of traditionally mid-term rentals, you think of travel nurses. There is a space, mid-term rental insurance space, that we've tapped in, where you need to be well connected with insurance and relocation specialists and companies and understand the right type of asset required for you to be able to help these families. What's really important that stands out the most, which you can get in what I'm about to offer you, is the understanding where to be found by these insurance companies, how to properly manage your calendar so that your listings are optimized so that they can find you, how to actually gain traction and build a relationship with these relocation insurance companies. I've put together an MTR insurance blueprint. That's MMTRRR insurance blueprint to cover these foundations after we've had success landing very large contracts on single family homes that literally 4x what we traditionally make in long-term rentals, and also gives us peace of mind because there's less turnover and 100% occupancy, because these contracts can start anywhere from 30 days to 3 months to 8 months and range anywhere from, again, we've landed anywhere from $8,000 to $9,000 a month per month on a single family home property, which our mortgages are typically around the $2,400 range, which then gives you a large spread of anywhere from 4 to 6K net on just one property. And this is why it's very hot right now, but people who haven't been in the lab with individuals like myself, like Jesse Vasquez and Dr. Rachel Gainsborough and Noble Crawford, don't have the foundations and don't know exactly where to start. And therefore, this is why I'm giving you guys a blueprint, the MTRR Insurance Blueprint. Go to the website, experimentrealestate.com, and get yourself a blueprint to completely change or at least have a plan B if you're a short-term rental operator looking to maximize your occupancy and profitability. We'll see you on the other side. How humble of you to say. Of course, yeah. I doubt that to be the case with the success you're having. But I guess, what does that look like? Yeah, I'm curious.
Yeah, so I visit each property far more than most third-party management companies are going to do. I spend time and I talk to the tenants, whether it's at our self-storage property or if it's our office property. You know, I'm just there and available, and you always find out something when you're talking, and usually you're going to find out something before it becomes a problem, hopefully. We work our vendors pretty hard, getting really, really good agreements in place, or testing more vendors. And so I really hope that that a lot of this starts to pay off and we're not investing 3x time. But as it is right now, we're just doing things that most third-party management companies won't do. And it's not that they're bad people. It's that when you're dealing with smaller properties, and most of ours are 15 million and under in value, and they take their 5 or 8% of rents collected, and you boil it all down to, you know, in one property and that I'm thinking about, well, you know, that's $60K a year. I mean, how can they afford to have top-notch people without a vested interest and keep good people? The only way they can afford to do that is to go get 10 more just like it. And then they get spread too thin, or maybe they do 15 or 20 more. So I think it's just a problem with the model.
I was gonna say that, yeah.
And so it's just something that we've taken on. And I've tried it many times in the past, and trust me, I would love to be out of the day-to-day. I would love to not be dealing with credit card issues at the storage facility, or you know, the dentist has overflowed his toilet again. You know, I'd love to be out of that business, but somebody's got to do it, and it's got to be done right, and because our money is in there along with the investors, you know, we are willing and able to do it. So.
Yeah. And can you talk about those two asset classes? Because I heard you say storage and office. Could you, what's your current asset, the asset types that you typically go for that you currently have right now?
Currently, our focus is commercial asset types in the Tennessee Valley. And so that's generally south of Nashville and including northern Alabama. So, and commercial is multifamily, storage, office, industrial. And so we look at all of those. We're highly keen on multifamily, but from a data point standpoint, because suburban office and storage will correlate very directly with multifamily development in units. We currently don't have any multifamily, but it's not for a lack of trying. We find most of it to be pretty expensive, but we're very keenly aware of what's going on in multifamily, because that's we want to be following that pattern. We want to be following that trajectory, and you can do that with lots of different asset types. Storage correlates almost directly, and then you've got, you know, small retail, what I also call suburban office, that correlate very closely to multifamily as well.
Got it. Yeah, and I apologize because I sometimes put them in the same bucket. And I think in the intro I might have even mentioned multifamily, but what I do mean to say is commercial, and we're in
Yeah.
a commercial space as well. What's the kind of I find storage units to be fascinating as far as you talk about property management, and then you talk about storage facilities, and you get the sense, I don't own any, but you get the sense that they can pretty much be automated. Tell us about that. Like, how many units is it, and what does the overhead as far as like work and labor look like compared to? It sounds like you have also some commercial dentist offices. Can you talk about the difference between the
Yeah,
two?
sure. Yeah. So storage, it's a bit more retail than any other asset class, perhaps even more so than multifamily. I mean, it is automated. We have 2 facilities. None of them are full-time staffed, which we like.
Keeps it lean. Keeps it lean.
It keeps it lean. Office expenses we keep below 20% of rents. Yeah,
And how many units are those? How many
uh,
storage units?
we have 125 in one and 30 in another, where we retrofitted some storage into an office building that we acquired in Huntsville, and it was just sort of a strategic play. I mean, storage is the highest grossing rent per square foot of any of the other asset classes out there, and it has the least amount of infrastructure to be built. Storage does require an awful lot of rooftops or housing units in close into the geographic area. So it's not like you can just go do storage all the time. People do storage close to where they live, which is why storage correlates so well with multifamily. But we like the storage, and we're happy for others sometimes to do the housing or the multifamily piece of it. Like I say, it's a little bit more retail. Everything we have stays full. And we've been aggressively raising rates and sort of testing what the upper limits are. We've slowed down a little bit this quarter, just trying to figure out where the economy is going. But they are cash cows, and have very few problems. I like to say doing storage is like doing multifamily without the toilets.
Yeah, no, that's funny. I was thinking that. So let's go through an example. How when you talk about a one storage unit, what is the size of that? Is it as the size of a room? Like how large, or what's the square footage on that?
We have opted for the larger units. I think if you talk to most self-storage people, they'll tell you they never have enough large units. They turn over very slowly. In our facilities, they're all 1,000 square feet. They're all 20 by 50. They're originally built for RVs and boats and things like that.
Wow.
What we found is a business customer who might be a small business, and they need a place to park trucks, store some inventory without going out and renting a whole office warehouse type of thing. So they can have a facility for $500 a month. And it's they love it, and a lot of them come along and pick up one or two.
And is that would you say the average rate you guys are kind of $500 a month? Would that be the sweet spot?
Yep.
Okay. And what would be the if you were to do the math, the price per unit when you think of your ROI, because you were talking about that earlier about how you get high IRR, but what is price per unit when you do the math?
Oh, the value per unit. What?
Yeah. Is that how you would say it, the value?
Well, if we were going to sell it,
Mm-hmm.
yeah, we'd be about $115,000 a unit.
Okay.
And
that's really interesting.
Yeah.
And so are you guys? We're in the short term / midterm rental space, so we leverage a lot of technology with property management software, slodge locks, etc. What is being used at each unit for one person to get in and out? Is it smart locks? Is it a centralized system? Like what? How is that
Yeah,
operating?
it is a keypad that's cloud-based enabled. We have a combination of three keypads. We use non-duplicatable keys on the individual units that we can change out very quickly in case somebody gets behind. So they might be able to get in the gate, but then they won't be able to get in their unit. And so that's not very technological, but the gate, which is essentially the entire business, yeah, I can control that from my cell phone.
Oh wow.
I mean, and there are several good software companies out there for storage, as you might imagine, and most of them are really good, high tech. Yeah, so yeah, we have to have an internet connection there that talks to a computer that talks to the gate, and so I can lock somebody out and wait 2 minutes, and then it's uploaded to the gate, and or vice versa. You know, they
Oh.
call in and pay their bill, and we can unlock them just like that.
So that's probably not ideal for you though if someone's not paying their bill, because then it's not like you're removing and freeing up that storage unit, right? It's just how it's not like it's not you're not producing any income, and how
Yeah,
does that work?
they eventually do. To me, it's not any different than when I was doing residential rentals. You've got people who haven't paid by today. You know, see, today's the 5th of the month. At stroke of midnight, you know, all those people who quote haven't paid, they'll be locked out, you know, by the computer.
Mm.
And so we have the usual suspects, and you know, I don't have any real problem ones. They'll get charged a fee tonight, and then they'll log. They can either pay online through the portal, or they can call in to the office, and then we'll process it. And we've now started charging them a fee for having to call us because they can do it from their phone or their computer just as easily. And it's and most of it's just what I call management.
Mhm.
Is it not ideal? No, it's not ideal, but it's the world.
Oh no. Yeah, I was just trying to understand because this, you have eviction and then there's storage units, and what's for the as far as the life or the retention rate or the typical, lifetime. I don't want to say lifetime value, but
Oh,
length
I
of
think that's the
lifetime.
right. I
Is
think
that
that's the right.
yeah?
I mean, really, rental real estate of all classes is a subscription business of a kind.
Right.
I like to say it's the original subscription business. So I
Mm.
think lifetime value, average lifetime, in the storage business, um, our facility is new. We bought it fairly new.
Mhm.
And right now we're tracking a lifetime, average lifetime of over 3 years. And in these big units,
Oh, that's a long time. My
it is
gosh.
a very long time compared to
Jeez.
traditional storage. And, you know, and once these people, especially these businesses, once they move in, it ain't easy to move out, you know. So, yeah, I'm not complaining about that. We're very pleased with it.
What did you acquire that one at?
Uh, we acquired that one at $9.2 million.
Wow, that's a those are some really interesting numbers. That's really neat. And so I love how you said that because I've heard that before. We've obviously looked at the data, and so you look at. I'm very curious. I wonder what the correlation is on this. Do you find that I don't know if the data is out there, so I'm just shooting my shot here, Stuart. Do you find that in areas where storage is needed, individuals live more in single families or apartments and or business? Like, what's the data correlation that you look at when making that investment? Are you looking at like population per square footage, or are you looking at, you know, amount of individuals per specific area? Like, what is that key metric that's like, that looks like a slam dunk, let's go in there?
Uh, you can get a lot of different answers to that question. And
Mm-hmm.
there are people who are more expert in storage than I am.
Mm-hmm.
Um, to me, I look at total housing units around. We have people that live in apartments near us, but own a $750,000 RV that they park in our, but they live in an apartment. So I have a hard time making those kind of generalizations. Typically, though, apartment dwellers are going to probably opt more for the 5x5 units or the 10x10s.
Mm-hmm.
Your business customers are going to be going for anything from the 10x20s on up. This facility that we acquired was specifically targeted at boats and RVs, because there's a lot of high-end neighborhoods around that don't allow those things to be parked in them. So it was a good strategy on the developer's part, and that's probably what about half of our units are filled with, and the other people use it for business.
Yeah, no, that's great. I guess if I wanted to make my answer even is more sharp. In the short-term rental space, we look at average daily rate, we look at occupancy rate, and we look at like a long span within the last 3 years. I was going to ask you, what gives you peace of mind when you're about to write an offer on a deal that the data is going to back my decision to buying storage? I think that's more of the question I was going to ask.
For a new deal, I'm going to focus heavily on the occupancy rate and the longevity of that occupancy rate. That occupancy is everything to me. Secondarily is are they occupied because they're too cheap? And what are they? Are they at market? And typically, you'll find that they are. So, to me, occupancy. It is a retail business, so I don't worry too much about turnover, because you're going to see turnover. We have fairly low turnover with our facility. It's got 125 units. We're going to see 2 to 3 every month. It's not forever. People give a proper notice. No problem. We'll be here next time you need one. The other thing that I like to see, not every facility tracks this, is a waiting list. When you're full, how good are you at keeping up with the people who want something? In our market, almost everybody's facility is full.
Really?
Yeah, and so when one comes up, we want the list of all these people. Now, they're not putting down any money and they're not reserving a spot or anything like that, but we have a healthy, our average turnover when we get a notice is we have it re-rented within 24 hours, and sometimes the other guys move out.
No way. 24 hours. Wow. That is huge.
Yeah.
I thought you were going to say like a week.
No, we had a little bit of softness in June, and I was kind of freaking out when we had 2 available for 4 days, but it didn't last that long.
Wow. I will take that any day. My goodness.
Oh, yeah.
That's really impressive and probably not even talked about enough. I didn't realize that the demand was that big. I mean, it just, now you're talking about a whole, and this is why I love having, someone like you on the show, just that paradigm shift of, for someone who's out there and you're still looking for a strategy or want to invest with someone like Stewart, and this interests you and you understand, because I always say, Stewart, people can only do business with you when they understand it. I think this is a great case study to see how shut up and take my money, of course, right? The data speaks for itself, right? I mean, even just hearing that, it's like having some extra capital, be like, all right, let me deploy it to this niche, to this, diversified asset. So good for you, Stewart. I mean, you're a numbers guy, so I'm not even shocked one bit. Tell me about, because I want to put a bow on this. Storage is slam dunk, makes sense to me. Say less, no toilets, got it. Why go? Sounds like offices, commercial. You talked about dentists. I don't know if that was an example. Talk to us about the other side of the commercial that you got your hands in.
Yeah. We've got 2 other properties. One of them is a medical office building. So my perspective is, we've all been hearing the doomsday for office, since 2020. Well, office is actually made up of about 6 different subcategories.
Talk to us.
There's what I call suburban office. Some people classify it as retail. There's medical office. And guess what, people? Your doctor's not going remote. Your dentist he is not coming to see you, and he can't clean your teeth via Zoom. And so medical office buildings are, to me, some of the greatest assets out there. And even in the light of what we just talked about with storage, there are certain industries that are legally required or contractually required to have space. Your average State Farm insurance guy, they're legally required to have space. Mortgage companies are legally required to have space, whether they're in there or not. They have to have the space.
Didn't know that.
Doctors, dentists, lawyers and accountants. We can be anywhere. And so whether or not you have space depends on the clients that you want in your practice. And so the assets that we like, and I love office. I've just sort of had a history of it, but what we are looking at, we're not pursuing any Class A office at the time. We don't own any. I would love to, just from aesthetic, Class A office buildings are all beautiful. They got marble floors, and I just want to live in the bathroom sometimes. They're such places. But Class A Central Business District offices, they got a problem coming, because those are the employees who don't want to go back to work. The other office properties, like we have a suburban, it's in Spring Hill, Tennessee, about 30 miles outside of Nashville. It's 1 mile away from what was the original GM Saturn manufacturing plant, but it's where they're building their EV battery and EV assembly plant there on that same campus. It's a thriving community. It's 30,000 square feet. It's been full for 5 years, and with no hint of vacancy. But I got dentists, I got mortgage companies, I've got a bunch of other consumer-facing tenants. So that's what I'm looking for. Who are the tenants in the building, and who do they do business with? Because here's the real trick for any of you. Whoever your tenants, whatever business your tenant is in, you're in that business as well. And so it's the downtown places where people are reducing space or not renewing leases and whatnot. But like I said, the dentist isn't going anywhere. I have 2 home health companies in that building, and they use it as a gathering place for their employees, once a week, and they do that. They scatter those all around their geographic area.
Yeah.
And so they have to have something.
Do you mix, Stewart, different businesses? Because I'm assuming if you had like a building of a bunch of dentists, then obviously there's competition there. So when you think of the layout, when you're picking that kind of asset, I have so many questions. Is one, what kind of asset? And are you doing it where you could have the lender on this floor, the dentist on this floor, the mortgage company on that floor? Like, are you being strategic across having like a horizontal kind of let's make sure we can tackle each avatar, or you're looking at individually like, oh, we found a great space and this would definitely speak to this specific avatar? Like, how are you seeking out commercial real estate from that lens?
If I were to say yes, Ruben, I do that. I mean, you're a lot smarter than I am. I find that the tenants do a pretty good job of ferreting out their own competition. The two dentists don't want to be in the same building. I've seen it happen. I don't have any of those situations in any of my properties. And I'm not sure I would, I typically don't do leases that have those kind of restrictions. Although sometimes you do see that where the dentist says, you can't let another dentist in this building. And sometimes they're a big enough tenant to make that call, and other times, you just disagree. To answer your question, the way I'm looking for properties is cash flow first, and then I start looking at the quality of the cash flow. I like a nice mix of national tenants and local tenants, which you typically find in your suburban building. Like, I like having Edward Jones offices in there because those come with corporate guarantees, or an H&R Block mixed in with the local optometrist guy, and so forth and so on. I think it's good to have a nice healthy mix, and I like multi-tenants because I've seen too many single tenant operations just say, well, we're out of here.
Yeah.
I guess you can sue us. I mean, I saw Dollar General do that, 15 years ago. We've all seen multiple theater companies, whether it be Carmike or AMC, just, here you've got a building that's specifically built just for movies, and they say, well, we're out of here. Somebody else built with a nicer one. Yeah, I mean, they act like they're professional football teams, and they just move cities. And I mean, I don't know what you do with that kind of an asset.
Yeah,
I like the I guess the stability of multiple tenants.
Multi-tenant.
Yeah, it is more complex, but that's on the manager, not necessarily on the investor.
Yeah.
And I like putting them out there where you, all right, I just booked you for a new 5-year lease or a new 3-year lease.
Yeah.
I don't have to sell that one again next month.
Yeah, 100%. Well, that's what's going to be the next question. When you're buying these, right? And I'm so glad we're talking about this, because I don't think we've ever had someone who is that deep into the retail space. Is it like you're buying, when you buy a multi-tenant building, it's like it's being sold and the contracts are being assumed by you? Is that how it's structured?
Generally, at the closing, the owner will assign the leases to the buyer, and all the tenants are notified. Depending on the size of the deal, you might do something that's called a lease estoppel, where the seller has to deliver a letter to you signed by the tenant where they say, yes, these are the terms of our lease and that we agree to.
Yeah.
So it depends on the size of the deal, whether or not you go through that.
Sure. And when you're working with like a Dollar and an H&R Block, are those like, how long are those deals usually typically, or leases typically structured for?
In the assets that we like, 5 years.
5 years.
Typically, the longer leases will go to the medical guys because they do so much of their own build out. I just renewed a 10-year lease with a dentist, and he's pumped hundreds of thousands of dollars into his space. In what building he doesn't own. So.
Oh, that's pretty incredible.
Yeah.
Do you ever structure like a triple net lease or anything like that? Is that common, or is that like not a thing anymore? Or how does that work?
No, it's totally a thing. I wasn't quite sure how that would work in a multi-tenant environment, although it's become quite the thing. As a sponsor, as an individual, I might go buy a triple net property and just clip my coupons. But as a sponsor, there's really no benefit for a Harvard raised capital bringing your traditional single tenant triple net to market because what do you need us for? But in Nashville and other markets around the country, we're seeing more and more and more triple net office multi-tenant leases, and it's really quite brilliant. And all that means is every single operating expense that the building has, including management, is going to pass through on a pro rata basis to the tenants. So in two of our buildings, we're moving to that model, but it's the kind of move that takes years because you have to let leases expire.
Yeah.
But to the extent that that's the market, and we're seeing that in higher end properties in Huntsville as well. And as an investor operator, I love it. So, rent equals NOI, and all other operating costs, basically get passed down to the tenants.
Yeah. Wow. Well, I think we've come full circle, and Stewart, I got to tell you, man, we got nice and juicy in the end. You could see how excited I was getting, because numbers talk, right? And I think that's why you're having the success that you're having at Harvard Grace Capital, is that the numbers talk. And what I love is having a high barrier of entry, right? I think that there's it goes without saying that there's something with having that niched knowledge in the marketplace where, like you said, it takes years to foster these relationships. It takes a level of expertise to get into the game and understand a different product, a different asset that brings back high returns for your investors as well. So it's amazing to have you here in the lab, because that's what we talk about, right? If we bring this full circle, it's you came in, you saw this, as an experiment, as a case study in your day-to-day job, and you said, I'm going to take a leap. Then when you took a leap, you also, what I heard that you did, Stewart, and please correct me if I'm wrong, is you knew exactly what you did want, and you knew exactly what you didn't want. All right. And you knew that you wanted to be in control. You knew that you didn't want to build the business model that you first came in as a CPA, but you took those skill sets and what we say is you brought it into your lab, and you then rolled it into a new experiment to then still be in control, but still leverage the capital of others to then be able to go into very niched commercial verticals. So kudos to you, sir.
Well,
and we'll definitely be watching and keeping close. What's one thing, biggest lesson learned or key insight that you wish you would have known earlier in your years of experience being in the lab, as we call it, that you'd like to leave with Experiment Nation today?
Do not underestimate your need for capital reserves. I've had trouble over the years. I had trouble back in 08 and 09 where I had lots of assets, but no reserves. I was convinced, even as a CPA, I was pretty aggressive. I was on my own. It wasn't other people's money back then, but you don't know what's coming down the pike. I ask for anybody who's been on your show, a year ago, who would have thought that the Fed would have raised interest rates 5.25 points in the last 12 months?
No one.
No one.
Was on no one's radar.
No one. Well, I mean, there were many of us sitting around, when are they going to start raising? Because I thought they should have been raising in Q4 of 20, when the economy was clearly roaring. But, they waited until 22, and they knew they were behind. And, I don't think they're behind anymore. We'll see what they think this month. But nobody knew that.
Yeah.
And be very careful with your floating rate instruments. Everything we do on stabilized properties is fixed interest rates. That might cost us something later on, but we've lost no sleep over the last year on any of our assets because we're fixed rate. Fed can do what they're going to do.
Yeah.
The biggest impact they're having on us is they're impacting our potential sale price, because interest rates impact cap rates, but we're not selling anything.
Yeah.
So, it's made deals more difficult to do.
Yeah.
Which is why we've passed on several. The sellers still want cap rates in the 5s and low 6s. Really? When interest rates
These
are
rates.
7.5 and 8?
Yeah.
That math doesn't work. So, anyway, reserves.
What's I love giving tactical. What's a good rule of thumb that you feel, you being the numbers guy, whether it's a percentage or a certain amount of number of months that you should have as a runway, as we kind of close this one out? Because I love that you finished with that. I think it's so timely. But what does that look like tactically? Should you advise?
I like to go with 6 months of net operating income. So that is enough to cover your note for 6 months, assuming you had no income whatsoever. You got multi-tenant properties, or you got any kind of income property. You're likely not going to go to zero income unless there's some sort of a natural disaster. So, more than 6 is too much, in my opinion. Less than 6, you're taking a risk. So,
I love that. Well, Experimentation, you heard it here. Stewart Heath, CEO of Harvard Grace Capital, came into the lab, give us some gems, give us some insights to how he's cooking in his lab, and also give you some notable gems that you can take away. Stewart, where can the individuals tap in more with what you're doing to see, what you're up to and stay in touch? How can we stay in touch with you, Stewart?
The best place is go to harvardgracecapital.com, all spelled out. I invite everybody to go to resources. We have some resources there, like how to evaluate a passive investment sponsor. It's a checklist that you can use. It's completely free. You can find my Calendly link there. I invite anybody and everybody interested to talk real estate, book some time with me. I can talk real estate all day long. And just check us out and reach out. We'd love to talk with you.
You heard it. HarvardGraceCapital.com. Make sure you check out what Stewart Heath and his team are doing. Incredible job, Stewart. Looking forward to have you back here in the lab. And just like that, Experiment Nation, we are out.
Experiment Nation, your host Ruben Kanye here. Listen, if you're looking for a who in your next steps as a short-term rental host or Airbnb host or operator, that is, definitely make sure that you reach out to me directly by booking a call to see how you can get yourself to the next level. If you've never turned a house and repurposed it into a short-term rental or Airbnb, if you don't know what pricing tools to use, how to set up your listing so that's best optimized, how to set up a PMS software, let alone if you don't know what a PMS software is and why it's important, to, again, having dynamic pricing as a tool to stay ahead of your competition, to always be booked and not only be able to pay your mortgage, but cash flow some, and always make sure that you're giving your guests an experience that will have multiple other guests want to stay at your property, how to automate reviews, how to automate check-in details to messages for the guests, and so that you are no longer working in the business, but you're working on the business, how to build a virtual cleaning team, all of the above. Make sure that you go to experimentrealestate.com/hospitable-hosts, where you can book a call to see if you're a good fit for the coaching program that I am offering only to limited partners. If you're a part of Experiment Nation, if you're new to Experiment Nation, well, it's all about having the right individuals help you guide you through the next steps of where you're trying to go in your experiments. So if you're looking for guidance, if you're seeking out guidance, someone to help you, I am rolling out a new coaching program that is very hands-on. Therefore, there's only limited spots available where you will work with me directly, and I will help you take your short-term rental or your long-term rental into a short-term rental if you've never been a host before, or help you get to the next level. So make sure you go to experimentrealestate.com/hospitable-hosts so that you can take your experiments in the short-term rental space to the next level with a guide and someone who's been there before. Again, I look forward to seeing you on the call. Make sure you book a discovery call. We'll see if we're a good fit for one another. And again, be sure if you're driving, if you're currently not available, to take the URL down. It will be in the bio description. Looking forward to seeing you on the other side, and continue to experiment wisely. Happy hosting.